Hello and welcome to our special Saturday News Bulletin. I'm Ritu Singh and with me is Abhishek Kothari, and we're joining you here to talk to you about the big numbers that have just come out a short while back, and that is State Bank of India's third quarter numbers, broadly in line with what the streets had estimated. Profits are up by over 62% over a year-on-year basis. Net interest income, that is up by 6.5%. Provisions have come down sharply during the quarter. The good news is on the asset quality. The fresh slippages or the gross slippages both are actually far lower than what the street had estimated. Gross slippages at 2,579 crores compared to 4,292 crores in the previous quarter. The gross and net NPA ratios have also come down. Gross NPA to 4.5% and net NPA to 1.34%. The overall restructuring under COVID 1 and 2, that is also just 1.2% of total advances at about 32,895 crore rupees. Loan growth, that remains in single digits. Abhishek is also joining me now. Abhishek, overall in line with estimates?
It's a very strong quarter for SBI. Just look at the internals, the loan growth on a sequential basis at more than 5% is perhaps the highest in last 7 quarters. On a YOY basis, it has come in at 8.5%, which is the best in last 5 quarters. Remember that, just to alert our viewers, the systematic growth was also robust as on 31st December. The system growth was 9.16% YOY and about 6.65% sequentially. For the first time, we are seeing HDFC Bank's sequential loan growth to be on the lower side when compared to SBI's loan growth at 5.3%. Another internal that I can tell you is that the slippage ratio. Now, the annualized slippage ratio at 0.4% is perhaps the lowest in their history, or at least 25 quarter low that I have in my Excel sheet over here. So let's take off the Q3 FY21 numbers, given the fact that RBI dispensation was there. If you take that out, the slippage ratio is perhaps the lowest in last 25 quarters. The SMA 1 and 2 book, or let's call it, the watch list that the management does call, is at 4,167 crore when compared to 6,700 crore in the previous quarter. That's down about 37.7%. Even this is at a historical low of 0.16% when compared to, about 0.26% on a sequential basis. So, the balance sheet is actually strengthening up with lower stress going ahead, and incrementally you can see the loan growth coming ahead. So it looks good on balance sheet parameter. However, PNL, both the NII and PAT is about 105 to 107 crore. That, misses our estimates, but no complaint given the fact that, stress assets in the overall balance sheet has reduced drastically. Back to you.
Okay, we're joined by some market experts to make more sense of the numbers that have just come in. Prakash Diwan joins us on the phone line now. Prakash, your first sense of the numbers looks like a very good quarter for SBI. Any surprises there for you?
Yeah, well, absolutely, Ritu. I agree. The numbers are stellar. And, the fact that some of the P&L items may probably be a bit soft as compared to the expectations that had built in is good news, because what it does is it tells you that the good part is still to come, because the balance sheet is what's gearing up to be absolutely in a great position. And remember, the current quarter, Jan, Feb, March, is usually where the recovery rate is very sharp. And I wouldn't be surprised if the watch list actually shrinks to about 1,500, 1,800 crores, which is nothing for a balance sheet like this. So what we are doing is we are gearing up. These numbers tell you that last quarter was good, but the subsequent quarters could probably be stellar or even more superior. So, and that's what the market would like, given the way the stock has run up. Expectations were a bit high, and I don't think there would be any disappointment come Monday.
Well, stock was at a 52-week high ahead of those numbers. Ashutosh Mishra of Ashika Stock is also joining us now. Ashutosh, what stood out for you? As Prakash was saying, do you expect an even better performance going ahead based on the trajectory that we've seen?
Yes, we are also expecting SBI performance continue to improve over next at least 3 to 4 quarters. What is pleasing, apart from the other thing, is that loan growth of SBI is improving on quarter-on-quarter basis also. So last quarter we have only 0.5% sequential quarter growth over first quarter to second quarter was there. This quarter is a far healthier growth we have seen for the SBI. So picking up the growth is also good for sustainability of the NII. And on the asset quality, surely we have got pleasant surprise on the fresh slippages. And it has come to one of the lowest level if I last few years.
Yeah.
And restructured assets is also far lower than the many other players if you look at industry. So all in all, this is a very good set number on each front. And going forward also, picking up of the loan growth on sequential basis is clearly indicating that the sustainability of this earning trajectory will remain there for SBI.
Okay, we're standing by to hear from the management of State Bank of India, but in the meantime, we also have Darpin Shah of Haitong Securities joining us on the phone line. Darpin, quickly, your first thoughts on the numbers?
Yeah, so the previous two guests mentioned the same things in which I'd like to comment about. Loan growth picking up, asset quality improvements, slippages at multi-quarter low. These all are perfect. It's like a picture perfect for SBI for a smooth ride from here on. And just to add, even in terms of stressed assets, if you look at the SMA number,
you guys have been admitted finally. Sorry, Darpin, please continue. Please continue.
Yeah. So if you look at even the stressed asset numbers or stress book numbers, in terms of SMA restructuring, they are hardly, and it is just a minuscule number, which clearly indicates that SBI should have a good runway from here on.
Darpin, I'll just comment two key points that I liked. 14% ROE. I don't remember the last time that I saw in last 4-5 years. SBI reporting a 14% ROE, and their credit deposit ratio has also improved. By about 282 basis point on a sequential basis, now close to 69-70%. The trajectory on loan growth, as you said, has improved, and that has led to a good CD ratio or credit deposit ratio. What's your own estimate in terms of, from here on, will this loan growth trajectory continue, and would you see further improvement in its return ratios?
See, as you mentioned, the 14% ROE, if I recollect right, it was prior to 2012 or 2013. So FY 12-13, they had slightly higher ROEs, if I am right. So on expectations on loan growth, yeah, we expect the overall system should report a higher trajectory or improving growth trends. SBI being the largest player, along with just 67% CD ratio, balance sheet much healthier compared to previous cycle, they should be able to also report a higher growth in coming quarters.
Okay. One question to Ashutosh. Ashutosh, what do you make of the improving trajectory? Same question that I put to Darpin. What do you make of improving trajectory, especially on the loan growth? And what would be your ROE estimate for SBI going ahead?
So surely, this is very encouraging that we are seeing the sequential growth in the loan book picking up for the SBI, and that is a very important from the future sustainability of the NII growth. Because if you look last 2 years, a major driver of earning was decline in the credit cost, but almost credit cost will be bottomed out in the next 1 or 2 more quarters. So future sustainability of the income has to come from the incremental loan growth, and that's what is start flowing in. So that's a positive. And on the ROE front, I clearly see SBI delivering 15% plus ROE easily in FY23. And important things to watch next year will be like, we are seeing a lot of things is happening on the bond, the debt market side. And how really cost of deposit is going to pan out, that will be an important factor to watch out from here. We are seeing that 10-year is at roughly 7%, whereas the home loan rate is lower than that. This anomaly cannot continue. So either things will be correct out there going forward. So we need to closely watch that part of it. Rest of all, I'm assured that it will be surely whatever the situation will be, it will be able to deliver 15% plus ROE.
Okay. Prakash Diwan, one question from market perspective, given the fact that, the stress in the overall portfolio of SBI is at multi-quarter low, restructured book or the net NPA or any other stress asset, that you see SMA 1 and 2. How do you see the re-rating for the stock going ahead? Do you expect a further re-rating and the gap or the valuations to increase from here onwards?
So, Abhishek, that's an interesting area that you touched upon, because at the 52-week high levels, what is it the stock would be in a position to do? Can it reward these numbers more in a more amplified way, or will it kind of consolidate? My sense is, you've seen a balance sheet improvement, which could probably get even more stronger towards this current quarter ending March 31st, 2022. But in an interest rate, in a hardening scenario, usually there's always a lag. What Ashutosh also touched upon briefly, the cost of deposits will go up much later than the cost of loans will go up. So which means the spread will also improve. The margin profile of SBI is going to be absolutely different without provisioning, without NPAs eating into your balance sheet, which means that you will have to accord it a higher price to book multiple. And that's what it has always been suffering, because of a large balance sheet which could not get rewarded. But now the time has come where this balance sheet also is nimble enough to grow the way the ROEs are showing and the loan growth is indicating. I think the NIMs will also expand, and that is going to be the triple whammy. All three parameters actually leading to that re-rating. So I wouldn't be surprised if the stock actually starts looking up in a new zone from here on as well.
Darpan, do you also believe that we could look at a re-rating of the SBI stock going ahead significantly here from here on?
Yes, one can expect that. So just to touch upon the things which are already covered, in terms of balance sheet is much healthier compared to, say, last 3-4 years. Provisions are already adequate. Asset quality is improving and further should improve. So These all things will definitely lead to a healthy profit growth, a better return ratios, and which will drive the re-rating.
Ashutosh, anything else that stood out from you apart from the broad numbers that we have already covered?
One more important, if you look now, it will be to look at how really the ECLGS and restructure part of things is going on. So that requires some more. What I clearly find that SBI is relatively better placed compared to even the other 4-5 large private or public sector banks on that front. Within this whole debate, like we are looking at how really ECLGS portfolio is going to perform, because moratorium is going to end on that front. So we're looking forward to get from the management the perspective on that part of the thing, because now almost the whole of the moratorium is getting over.
Okay, Ashutosh, sorry to interrupt you there. The State Bank of India management is addressing the media.